This is a podcast from the Business Times.
How prepared are you for retirement? Apparently, not quite, according to many recent surveys. The SMU's Center for Successful Aging last year published a report looking into three older cohorts of Singaporeans, the Pioneer and Merdeka generations, and the so-called young seniors born in the 1960s to 70s. When young seniors were asked how they rate in their preparedness for retirement, half of them believed they were poor or fair. Less than 1 in 5 rated themselves as very good or excellent. Separately, the OCBC's Financial Wellness Index for 2023 found that retirement has taken a back seat to investments and debt repayment. I found one chart really interesting. It showed people are putting off planning for retirement. People in their 40s aim to start planning when they reach 54, and people in their 50s aim to start planning at age 60. This is worrying for obvious reasons. Why is this happening, and what steps can you take to ensure a good life in retirement? Welcome to Wealth with BT. I'm your host, Genevieve Cua, Wealth Editor of the Business Times. I have a guest in the studio. He is Christopher Tan, who founded a fee-only advisory firm, Providend, in 2001. Thank you for being with us, Chris.
Thanks, Jen. Thanks for having me.
So I've known Chris for a long while, maybe since you started your firm?
23 years ago.
Yeah.
Long time.
By now, Providend has been in the financial advisory business for more than 20 years.
20 years, yeah.
Going on 24 years, right?
Going.
It manages or advises around 1 billion Singapore dollars in savings. Chris, with all your experience, I'm hoping you can share some insights that can help people to rethink their approach to retirement. First things, in all your years as a financial advisor, can you distill for us what qualities do successful investors have in common?
Thanks, Jen. I think over the years, these are some of the qualities that I've observed from my clients. I mean, even though they use us as an advisor, but even before using us, many of them are actually very successful investors themselves. So the first quality I would say is they are prudent, because as the saying goes, if you cannot save, you cannot invest, because investment requires capital and capital comes from saving. So good investors must be good savers. Also, they understand the merits of spending below their means. This does not mean that they are stingy. They still save, or rather they still spend on necessary and meaningful things. But beyond that, they save as much as they can to invest for delayed gratification. Secondly, they appreciate value. So in the same vein, just like savings, I think good investors, they recognize value. And value does not mean that they only buy things that are cheap. It means that for the price they pay, they believe or they expect to be getting a lot more back. So that's what value means to them. And again, this does not apply to investing. I noticed that it also applies to other things in life. And thirdly, they understand what investing is and is not. And again, I don't mean that they must understand all the technicalities of investing, because not everybody is trained in finance, but they bother to find out. They know that investing is for the long term, and if they want high return in the short term, they know that that's not investing, that's speculating, which is risky and more uncertain. They also understand that cost is a factor that they have to look at. And fourthly, they are patient, because they understand, like I say, investing is for the long term. They are patient as long as they know that they are invested in the right things. So they do their best to ignore short-term noises and keep their eyes on the long term. And finally, they know what they need. I mean, they know the returns they need, and they are not greedy, because they know that they cannot always get the best returns. And as long as their investments deliver sufficient returns to meet their needs, they are contented. You know, they don't go around chasing the next big thing. They prefer reliability.
So now, Chris, I'm going to put you on the spot. On the way here, you've told me you are 54. So that makes you, against the official retirement age, maybe you have about 10 years to go. How are you preparing for retirement?
Well, I believe that, to plan for retirement, you really got to start with knowing what you want first. So I plan to retire quote unquote, from financial services in about 7 years' time. I've made this pretty clear to my team and my clients already. So we are actually in the middle of a 10-year succession plan. After that, I plan to spend my remaining years doing a bit of writing, teaching, but plenty of coaching. I want to spend my time coaching people who are down and out, the underdogs, those who may suffer a corporate burnout or they are lost in life, because I have a heart and burden for these people, and I know that there is a better way for them. I hope to be living in different places in retirement where there is plenty of nature, but Singapore will always be my home and I will be a Singaporean still. Based on all that I want to do, I broke down my lifestyle needs into essential and discretionary expenses. And for my essential expenses, I will use my wife and my CPF to fund it. I've also bought a retirement income plan many, many years ago, more than 10 years ago. So that will fund my essential expenses as well. Also, I'm currently pretty heavily invested into equities, into a portfolio which is managed by Providend. And when I'm nearer to my retirement, this equity portfolio will be most likely converted into bonds to give me a safe retirement income stream. All these investments, CPF, RI products, and with some people may be angry when they hear that, is what I expect my 2 children to give me, and they have been, or rather one of them have been giving me, should fund my essential expenses. And even if my children, they cannot afford to give us an allowance, I think that would be fine, right? And then when I finally leave my firm, if I can extract value from my business, then that amount should be able to fund what I call my discretionary expenses. So that's my retirement plan. Currently, I'm almost debt-free. I have a small mortgage. If I want to pay, I can pay off. I bought all my insurance, necessary insurance. So if I fall sick, I think that will take care of my medical expenses.
Retirement adequacy, as we hear a lot from the government, is a big concern, especially with higher inflation, higher interest rates, and markets being volatile. So how much do these factors matter, and what planning approaches work best regardless of such factors?
Yeah, so you are right to say that there are many moving parts. Therefore, the most reliable way to have retirement adequacy is not just about getting your investment right, but also getting your financial planning right. But I know your question is really on investing, so let's start with investing. So from decades of evidence, one instrument that has consistently beat inflation in the long term is definitely equities. There are enough evidence to show that despite all the short-term economic, geopolitical risks, equities have risen in the long run. But the problem with equities is that it is volatile in the short term, and this presents problems for both accumulators and retirees in terms of retirement adequacy. So for the accumulators, if they cannot stay invested for the long term, they will not get the returns that they need, and they may even incur losses. So having the ability to stay invested is very key to making sure that they accumulate enough for retirement. So it's not just about the investment giving them the returns. They must be able to stay invested to be able to get the returns, right? So good financial planning is very important. So good financial planning is about things such as having sufficient emergency fund, not overly in debt, adequate insurance coverage, and many, many others. Because if one does his financial planning properly, there is no need to sell in the short term due to changing life events. For retirees, it depends on when you retire, how the markets will behave. Because markets may be down and it's a bad time for you to sell your investments to fund your retirement lifestyle. And even though you are likely to still get positive returns if you have invested for the long term, you may not get sufficient returns, right? Because positive doesn't mean sufficient returns. So cash flow planning is actually very key in retirement. Having sufficient cash as your retirement age becomes nearer is very important so that you don't have to sell your investment in a bad market. And also it's important in your planning that you plan for buffers as well in retirement. So you see, it's very hard to answer a retirement adequacy question just on the investment side. I think investor needs to consider the financial planning side as well.
We hear and discuss a lot about financial issues like investment strategies in planning for retirement. But there are some non-financial factors that can really help enhance our senior years when we no longer have regular work. Your personal relationship with money plays a part. That's after the break.
In the latest episode of Lens on Singapore, we look at a disturbing global trend and ask the question, is anyone too young for cancer?
Which is when I went to the hospital for a full body check. And that's when they found out more.
Are young adults prepared to deal with the emotional, physical, and financial impact of facing such a daunting medical crisis? The Business Times podcast team goes behind the numbers to get some answers. Listen to Lens on Singapore at bt.sg or wherever you get your podcasts.
And now, back to WealthBT from the Business Times.
Welcome back to WealthBT. We've just been speaking with Christopher of Providend. Chris, what do you observe as people's biggest mistakes or blind spots in their retirement planning, and how can these be overcome?
I think firstly, investing the wrong things, largely due to the lack of investment literacy. So people buy based on tips or simply trust what they are sold or follow the crowd. I think to overcome this, investor needs to first invest in themselves. And by that, I mean personal development. So they should read relevant books and articles, attend talks, and listen to podcasts like this. Secondly, selling due to panic. Besides the lack of investment literacy, another reason why people sell due to panic is because they do not have the ability to stay invested. It's not that they don't want to, but they don't have the ability to. Therefore, getting your financial planning done properly, as I mentioned earlier, is very important so that one doesn't have to sell in the short term. So make sure that you have enough emergency fund, you have the time horizon, proper budgeting so that you have got sufficient surpluses and all that. And last but definitely not least is not selling when you should sell. So that's the opposite. Some people, they sell due to panic, but some people, they should sell, but they don't sell, right? I have observed that some investors have invested into bad stuff in the past and are unwilling to sell even when they should. They have this mentality that if they sell, they realize losses. But that's not really true because you only realize losses if you sell to cash. If you don't sell to cash and if you sell something that is bad and buy something that is better, actually you are reinvesting into something that will give you a higher chance of growing your money again. So these are some of the common mistakes or even blind spots that I have noticed.
Chris, you've also spoken and written a lot about people's personal relationship with money. So why is this important?
Because besides the need to stay invested and the ability to stay invested for the long term to get the returns that one would need, I think one's willingness to stay invested is also very important. And a person's relationship with money can affect his willingness. So, for example, if a person has a very bad experience in the past with investing, for example, perhaps when he or she was young, he noticed that the parents quarrel often because of the lack of money, and perhaps the father invested in the stock market, lost a lot of money, went to borrow money, couldn't repay, became bankrupt. This person is going to grow up thinking that investing in the stock market is very, very bad. Even that's not true, but he's going to grow up with this thinking and he's going to avoid investing altogether. And another example would be that someone has $4 million in a bank, which is a real example. I've seen it. $4 million is a lot of money, but this person is so afraid to spend money because he grew up in a very poor family and any signs of the bank balances going down scares him to death, right? So it's going to affect his wealth plan. And I think that if a person or even an advisor can understand his client's relationship with money, he can do a better job planning for the clients or even planning for himself.
You've also written and spoken about the concept of sufficiency and contentment. Can you explain this to us? What does this mean and why is this important?
The philosophy of sufficiency is the philosophy of recognizing one has enough. And one can only know that they have enough when they are contented. But contentment is not a passive acceptance of things. It is not, in our Singaporean term, no choice. Rather, contentment is an active pursuit of what is the most important things in life for you, knowing that you cannot have everything. I call sometimes these important things in life to be ikigai things. And the Japanese word ikigai means things that you wake up for in the morning or things that give you a reason to live. So to be able to have contentment and know what is enough, you need to spend time to consider what are some of these things that you will wake up for and the amount of money that you may need to enable these things.
And how can people kind of work this out for them? I mean, for retirees and pre-retire, just intuitively, it would seem that it's important to have this equilibrium, but how do you get there actually?
Like I said, I think it starts first with reflection, right? Sitting down and asking yourself, what are things that you want that is non-negotiable? Things that I do that will give me happiness, meaning, right? And then once you know these things, you got to do your financial planning and ask how much money you need to enable these things. Well, you may end up realizing that you have enough money already, and that's great. Or you may realize that you have so many things that are meaningful for you to do and you don't have enough money to do them. Then I guess you need to then reduce that list. So it's an iterative process, but it really starts with sitting down, asking yourself what are the non-negotiables that you must do. Yeah, so I think that's the start of the process.
Is there such a thing as being too late to think about it?
Well, I think as the saying goes, never too late. Because retirement is a very long time horizon, isn't it? I mean, I'm 54. You say I'm young, but actually I think I'm quite old. But if I happen to live up to my life expectancy of about 84, 85, I've got a good 30 years. So if I've not been thinking about this for the last 30 years, I think it's good for me to think about what I want to do in the next 30 years. So it's never too late. I think even if you are 60 years old listening to this podcast, it's still important to think about what you want to do in the next 10, 15 years.
Okay, thanks for sparing the time for us, Chris.
Thank you.
I often think of retirement almost like those stock images of a beach and sunset, but really the reality may be far different. Being financially prepared is one thing, but being mentally and psychologically prepared is quite another thing. But there are steps you can take to try to work out the values that matter most to you. It's something very personal, but it's also key to living a good life in your senior years. Until the next episode, thank you for listening.
This is a podcast by the Business Times. Find more BT podcasts at businesstimes.com.sg/podcasts. Or wherever you get your podcasts. This podcast is meant to provide general information only. SPH Media accepts no liability for loss arising from any reliance on the podcast or use of third parties' products and services. Please consult professional advisors for independent advice.